Hey, what's going on, guys? I'm back and I have this brand new spanking ETF that has been outpacing the overall market, and I'm really excited to share it with all of you. So this one, the ticker symbol is QGRW, QGRW, and it's provided by WisdomTree. So this is the WisdomTree U.S. Quality Growth Fund. So they're actually tracking the WisdomTree U.S. Quality Growth Index. So let's talk a little bit about the methodology the index uses to get the companies into this ETF. So they're actually going to rank the top 500 US companies by market cap. And unfortunately, this doesn't include any REITs or BDC. So none of those super high yield dividend paying stocks, they're sadly excluded. And then with those 500 companies, they're going to assign them scores based on growth and quality. So what do they mean by growth? Well, growth is determined by a company's ranking based on a 50% weight in its median analyst earnings forecast. And then 25% of that score is also going to be determined by its trailing 5-year EBITDA numbers. They're going to be looking for the growth there. And then they're also going to be taking into account 25% of its growth score with its trailing 5-year sales growth. So these are fantastic metrics to track a company's growth. That's what they're doing here. And then for the quality factor, they're going to use criteria such as 50% is going to go toward what its trailing 3-year average return on equity is, and then also what their 3-year average return on assets is. Overall, by using trends like this, we're able to understand the strategic planning of the companies, how it's utilizing its equity and assets to generate profits, and making those decisions on investments and just overall operations. It tells you what the best companies are doing with their money. They're getting a good return on equity, return on assets ratio there. Generally, the better these numbers are, the more stable and reliable the company's financial performance and health will be. And that usually translates to a very high share price. All right, so the index is market cap weighted once those 100 companies are selected. The maximum weight of any individual security is capped at 15%. The holdings are going to get adjusted every single June and December, so it's adjusted semi-annually, and the weights and components, that's all going to be adjusted proportionally as well. So when we look at the 100 different companies that are in here, we see a lot of big names, right? They've selected some of the biggest winners in the stock market in recent years. This includes companies like Nvidia and Apple making up 11% of the fund. Google, Amazon, Facebook, Eli Lilly, Broadcom, Tesla, Visa, they all make up the top 10 of this fund. These 10 companies make up 60% of the portfolio. You need to really like these companies, as just the remaining 90 companies make up 40% of the portfolio. So just keep that in mind, guys. 10 companies make up over half of the fund, more than half of the fund. The 100 companies in this ETF, they have an average PE ratio of 38, so not exactly super cheap. Now, that could be because growth companies, they often trade at a premium. These are often highly sought out after assets, highly sought out after companies. So when we look at the sector breakdown, you can see that they have 53% going to IT or tech, 14% going toward consumer discretionary, 12% at communication services, healthcare's financials, and so on. So this is another chance to get some diversification. Now, this fund is still relatively new. It's been around since November of 2022, so it's been around for about 2 years now. And they have an expense ratio of 28 basis points. That's going to be $28 for every $10,000 invested. That's not super cheap. I mean, the triple Qs are going for about 20 basis points. So it's a little bit more expensive, but as we're going to see here, guys, the performance has been super juicy. Also, the fund is pretty small. They have assets under management of just $474 million. Now, you might be wondering about dividends. Just let me know about the dividends, man. Just let me know. Well, guys, hate to break the bad news to you. Despite owning many dividend-paying stocks, this ETF actually does not pay out dividends. Any earnings or gains generated by the fund are typically reinvested back into the fund. This reinvestment can contribute to an increase in the NAV of the fund. Now, hear me out, guys. I know you're mad that the fund doesn't pay out dividends, but this is actually what I think is actually a good thing. And I actually kind of wish more ETFs had this feature. So when we have growth funds like this, the goal is to often maximize that capital appreciation over time rather than providing current income. Now, as a result, that NAV, it might actually increase because they're just reinvesting those dividends, right? So that NAV is going to go back up, then the fund should appreciate because it's not paying out those dividends back to shareholders. Now, I feel this is actually an advantage because getting a dividend distribution is a taxable event. But if the provider is just reinvesting it, that generally won't trigger a taxable event. Now, imagine owning this for years, for decades, watching your wealth grow potentially tax-free. Now, they did have a distribution in 2023 for a whole 4 cents. This is really just some special dividends. If they have some of those, they will pay those out, but don't expect those to be a regular thing. So no dividends, but it's not a huge concern because we can still have so many other great paying dividend ETFs like SCHD in a portfolio to add to that dividend complement. Now, I'm sure you guys want to know, how has this fund performed compared to the overall market and to other growth funds like the QQQs? Well, since 2022, the fund has returned a very impressive 91% compared to the overall market's 47%, and the QQQs, it even outpaces that by 11%. QQQs has returned 80%. So you can see in this little chart here, QGRW is the orange, the S&P 500 or the market is the blue, and the QQQs or the Nasdaq 100 index is the purple. So over time, QGRW has had a steady lead and it just continues to outpace the overall market and the QQQs. That doesn't mean this fund can only go up. It does go down, but it has recovered well and has continued to make its shareholders very, very rich. In the past year alone, QGRW is up 36%. In the year-to-date category, it's up 22%. We can see Seeking Alpha analysts have this as a buy rating. Long story short, guys, QGRW could be another fund that helps build wealth over time. It's looking at companies with growth potential. It has a short history of long-term capital appreciation, but in the short time it's been out, it has impressed. It gives you 100 different companies, so there's some level of diversification, and it gets balanced out twice a year to always ensure it's getting the best companies in there. And it's based on metrics and not your feelings. This is truly a set it and forget it ETF, helping us buy, stash, and collect cash. Thank you to all my Patreons for their continued support. We will be making more videos soon. We have Income ETFs Power Rankings coming up. Make sure you join the Discord to have some great conversations with other like-minded investors, and I will catch you on the next one.